Hello and welcome. In this course, we will explore investments in associates and joint ventures based on International Accounting Standard 28. The standard known today as IAS 28, which deals with investments in associates and joint ventures, was officially adopted by the International Accounting Standards Board in April 2001. However, its origins go back much further. It was first introduced in 1989 by the International Accounting Standards Committee. At that time, it served to replace specific sections of an older standard, IAS 3, which had been in place since 1976 and focused on consolidated financial statements. IAS 28 was introduced to provide clearer guidance on how to account for investments in associates. In December 2003, the accounting standard was updated and given the new title, Investments in Associates. This revision was part of the board's early technical projects and brought together guidance from 3 earlier interpretations, which addressed various aspects of equity accounting and transactions with associates. Later, in May 2011, the standard was updated again, this time with a broader scope and a new title, Investments in Associates and Joint Ventures. Then, in September 2014, further changes were made to clarify how to account for the sale or contribution of assets between an investor and an associate or joint venture. These updates aim to resolve conflicting rules on this topic. However, in December 2015, the mandatory application of these changes was put on hold indefinitely. In December 2014, the standard was updated to address how investment entities apply the consolidation exception. This change gave non-investment entity investors the option to keep using the fair value through profit or loss measurement applied by their investment entity associates or joint ventures when accounting for subsidiaries under the equity method. Then, in October 2017, further amendments were made to clarify how long-term interests in associates and joint ventures should be treated. Specifically, these interests, when not accounted for using the equity method, should follow the requirements of the Financial Instrument Standard. Over the years, other updates to different accounting standards have also led to minor changes in IAS 28. These include updates related to financial instruments, separate financial statements, annual improvements, insurance contracts, and the conceptual framework used in financial reporting. The standard known as IAS 28, which covers investments in associates and joint ventures, is made up of 47 main paragraphs, all of which carry the same level of authority. Even though the structure follows the original format from when it was first adopted, it should always be considered in the context of its overall purpose and the broader framework of financial reporting. This includes understanding the standard's objective, the supporting explanations provided by the board, and how it aligns with the general principles set out in the conceptual framework and the preface to IFRS standards. When the standard does not offer specific guidance on a matter, another standard, IAS 8, helps guide how to choose and apply suitable accounting policies. The purpose of this standard is to explain how investments in associates should be accounted for, and to outline how the equity method is to be used when dealing with both associates and joint ventures. It provides a clear framework for recognizing and measuring these types of investments in financial statements. This standard applies to any entity that has either joint control over or significant influence on another company in which it has invested. This standard uses a number of key terms with specific meanings. An associate refers to a company in which the investor has significant influence but not full control. Consolidated financial statements are those that present the financial position and performance of a parent company and its subsidiaries as if they were a single entity. The equity method is an accounting approach where the investment is first recorded at cost and then adjusted over time to reflect the investor's share of the changes in the net assets of the investee. This means the investor's share of the investee's profit or loss is included in their own financial results, along with their share of any other comprehensive income. A joint arrangement involves 2 or more parties who share control. Joint control means that decisions about important activities can only be made when all parties involved agree. A joint venture is a type of joint arrangement where the parties sharing control have rights to the net assets of the arrangement rather than to individual assets or obligations. A joint venturer is simply a party that holds joint control in such a venture. Significant influence refers to the ability to take part in the financial and operational decisions of another entity without having full control or joint control. There are also several other terms used in this standard that are defined in more detail in other standards. These include concepts such as control of an investee, the definition of a group, a parent, separate financial statements, and a subsidiary. While they are not explained here, they follow the meanings given in those related standards. Significant influence is generally assumed when an entity owns 20% or more of the voting power in another company, whether directly or through subsidiaries. However, this influence must still be evaluated, and it can be proven that significant influence does not exist in certain cases. On the other hand, if the ownership is less than 20%, it is usually assumed there is no significant influence, unless there's clear evidence showing otherwise. It's also important to understand that even if another investor owns a larger share, or even a majority, that doesn't automatically mean your influence is insignificant. Usually, signs of significant influence include things like having a seat on the board of directors or a similar governing body, or being actively involved in shaping key decisions such as policies on dividends or other important matters. Other signs that an entity may have significant influence over an investee include having material transactions with that investee, exchanging key management personnel, or providing essential technical information. In addition to direct ownership, significant influence can also arise from potential voting rights. These can come from instruments like share warrants, call options, or convertible securities that could increase the investor's voting power or decrease someone else's. When these rights are currently exercisable or convertible, they must be considered in determining whether significant influence exists. However, if the rights can only be used at a later time or depend on a future event, then they are not considered active for this assessment. When deciding whether potential voting rights give an entity significant influence, all relevant facts and circumstances are carefully considered. This includes the conditions for exercising those rights and any related agreements, whether looked at individually or together. However, the intentions of management or the entity's financial ability to use these rights are not taken into account. An entity loses significant influence when it no longer has the power to take part in the financial or operational decisions of the investee. This loss can happen even if ownership percentages do not change. For example, significant influence may be lost if the investee comes under the control of a government, court, administrator, or regulator, or through certain contractual arrangements. When using the equity method, the investment in an associate or joint venture is first recorded at its original cost. After that, the value of the investment is adjusted to reflect the investor's share of the investee's profit or loss from the time of acquisition onward. This share of profit or loss is included in the investor's own profit or loss. Any distributions or dividends received from the investee reduce the carrying amount of the investment. Additionally, the carrying amount may be adjusted to reflect the investor's share of changes in the investee's other comprehensive income. These changes might come from things like revaluations of property, plant, and equipment, or from foreign currency translation differences. The investor's share of these adjustments is recognized in other comprehensive income. It's important to note that income based only on dividends or distributions may not fully represent the true earnings from the investment, as these payments may not always match the investee's performance. Because the investor has either joint control or significant influence over the investee, it has a direct interest in the performance and returns of that investee. To reflect this, the investor's financial statements include its share of the investee's profit or loss. This approach provides a clearer and more meaningful view of the investor's net assets and financial results. When there are potential voting rights or derivative instruments that could affect ownership, the investor's interest is generally based only on current ownership levels. These potential rights are not usually considered unless certain specific conditions apply. However, in some cases, an entity effectively has ownership through transactions that give it access to the returns, even if the rights have not yet been exercised. In those situations, the investor's share is adjusted to reflect the expected exercise of these potential rights or instruments that already provide access to returns. IFRS 9. Financial instruments does not apply to investments in associates or joint ventures that are accounted for using the equity method. When instruments with potential voting rights effectively provide access to the returns of an ownership interest in an associate or joint venture, those instruments are not subject to IFRS 9. However, in other cases, instruments containing potential voting rights are accounted for following IFRS 9. Additionally, IFRS 9 applies to other financial instruments within an associate or joint venture where the equity method is not used. This includes long-term interests that are essentially part of the investor's net investment in the associate or joint venture. When applying IFRS 9 to these long-term interests, adjustments from this standard are not considered. Lastly, unless an investment or part of it is classified as held for sale under IFRS 5, it should be classified as a non-current asset. When an entity has joint control or significant influence over another company, it must use the equity method to account for its investment in that associate or joint venture. However, there are certain cases where this investment may qualify for an exemption, and in those situations, the equity method does not need to be applied. An entity does not have to apply the equity method to its investment in an associate or joint venture if it qualifies for certain exemptions. First, if the entity is a parent company that is exempt from preparing consolidated financial statements under IFRS 10, it can choose not to apply the equity method. Second, if the entity is a wholly owned subsidiary or a partially owned subsidiary whose other owners have been informed and do not object, then it can also be exempt. Third, the entity's debt or equity instruments must not be traded on a public market, such as a stock exchange or over-the-counter market. Fourth, the entity should not be in the process of filing financial statements with any securities commission or regulatory organization for the purpose of issuing instruments in a public market. Finally, the ultimate or any intermediate parent company must produce publicly available financial statements that comply with IFRS. These statements should either consolidate subsidiaries or measure them at fair value through profit or loss. If all these conditions are met, the entity is exempt from applying the equity method. When an investment in an associate or a joint venture is held, either directly or indirectly, through a venture capital organization, a mutual fund, a unit trust, or similar entities, including investment-linked insurance funds, the investor may choose to measure that investment at fair value through profit or loss. This choice is made in accordance with IFRS 9. For example, an investment-linked insurance fund could be one held by an entity as the underlying assets for a group of insurance contracts with direct participation features. This also includes investment contracts that have discretionary participation features. The entity must make this election separately for each associate or joint venture at the time of initial recognition. If an entity has an investment in an associate and part of that investment is held indirectly through a venture capital organization or similar entities, it may elect to measure that portion of the investment at fair value through profit or loss, again under IFRS 9. This is allowed even if those funds or organizations do not have significant influence over that portion of the investment. If the entity chooses this option, it must apply the equity method to the remaining portion of its investment in the associate that is not held through these venture capital organizations, mutual funds, or similar entities. An entity must apply IFRS 5 when an investment or a part of an investment in an associate or a joint venture meets the criteria to be classified as held for sale. If only a portion of the investment is classified as held for sale, any remaining portion that is not held for sale should continue to be accounted for using the equity method until the sale is completed. After the sale of the portion classified as held for sale, the entity should account for any retained interest in the associate or joint venture in accordance with IFRS 9. However, if the retained interest still qualifies as an associate or a joint venture, the equity method should continue to be applied. If an investment or a portion of it was previously classified as held for sale but no longer meets the criteria for that classification, it must be accounted for using the equity method again. This should be done retrospectively, starting from the date it was first classified as held for sale. The financial statements for the period since the classification as held for sale should be amended to reflect this change. An entity must stop using the equity method from the date its investment is no longer an associate or a joint venture. If the investment becomes a subsidiary, the entity should account for it following IFRS 3 on business combinations and IFRS 10 on consolidated financial statements. If the retained interest in the former associate or joint venture is a financial asset, the entity should measure this retained interest at fair value. This fair value will be considered the initial fair value when recognizing the financial asset under IFRS 9. The entity must recognize in profit or loss any difference between two amounts. First, the fair value of any retained interest plus any proceeds from selling a part of the interest in the associate or joint venture. Second, the carrying amount of the investment at the date the equity method was discontinued. When the equity method is discontinued, the entity must also account for any amounts previously recognized in other comprehensive income related to that investment. This accounting should be done as if the investee had directly disposed of the related assets or liabilities. If a gain or loss was previously recognized in other comprehensive income by the investee, and that gain or loss would be reclassified to profit or loss when the related assets or liabilities are disposed of, then the entity must reclassify that gain or loss from equity to profit or loss as a reclassification adjustment when it stops using the equity method. For example, if an associate or a joint venture has cumulative exchange differences related to a foreign operation, and the entity discontinues the equity method, it must reclassify to profit or loss the gain or loss that was previously recognized in other comprehensive income for that foreign operation. If an investment in an associate changes to an investment in a joint venture, or an investment in a joint venture changes to an investment in an associate, the entity continues to use the equity method and does not remeasure the retained interest. If an entity's ownership interest in an associate or joint venture decreases, but the investment still qualifies as an associate or joint venture, the entity must reclassify to profit or loss the portion of any gain or loss previously recognized in other comprehensive income. This reclassification applies to the part of the gain or loss related to the reduction in ownership interest, but only if that gain or loss would normally be reclassified to profit or loss when the related assets or liabilities are disposed of. Many of the procedures used when applying the equity method are similar to those used in consolidation under IFRS 10. The concepts behind accounting for the acquisition of a subsidiary are also applied when accounting for the acquisition of an investment in an associate or joint venture. When considering a group's interest in an associate or joint venture, this includes the combined holdings of the parent and its subsidiaries. However, holdings of the group's other associates or joint ventures are not included for this purpose. If the associate or joint venture itself has subsidiaries, associates, or joint ventures, the profit or loss, other comprehensive income, and net assets considered in applying the equity method are those recognized in the associates or joint ventures financial statements. This also includes their share of profit, other comprehensive income, and net assets from their own associates and joint ventures, after making any adjustments needed to ensure consistent accounting policies. Gains and losses from upstream and downstream transactions involving assets that are not a business, as defined by IFRS 3, between an entity and its associate or joint venture are only recognized in the entity's financial statements to the extent of unrelated investors' interests in the associate or joint venture. Upstream transactions are, for example, sales of assets from the associate or joint venture to the investor. The investor's share of gains or losses from these transactions is eliminated. Downstream transactions are sales or contributions of assets from the investor to its associate or joint venture. If downstream transactions indicate a reduction in the net realizable value of the assets sold or contributed, or an impairment loss on those assets, the investor must recognize those losses in full. If upstream transactions show evidence of a reduction in the net realizable value or an impairment loss of the assets to be purchased, the investor recognizes its share of those losses. When a non-monetary asset that does not qualify as a business under IFRS 3 is contributed to an associate or a joint venture in exchange for an equity interest, the resulting gain or loss should be accounted for as described in paragraph 28. However, if the contribution lacks commercial substance, which is defined in IAS 16 property, plant, and equipment, then the gain or loss is considered unrealized and should not be recognized. There is an exception if paragraph 31 applies, but generally these unrealized gains and losses must be eliminated against the investment accounted for under the equity method. They should not be shown as deferred gains or losses in the entity's consolidated statement of financial position, nor in the statement of financial position where the investment is accounted for using the equity method. If an entity receives an equity interest in an associate or a joint venture and also receives monetary or non-monetary assets, it must recognize in full, in profit or loss, the portion of the gain or loss related to the monetary or non-monetary assets received. When a downstream transaction involves assets that qualify as a business under IFRS 3 between an entity, including its consolidated subsidiaries, and its associate or joint venture, the gain or loss from that transaction is recognized fully in the investor's financial statements. Sometimes, an entity may sell or contribute assets through two or more related transactions. To determine whether those assets constitute a business under IFRS 3, the entity should consider if these sales or contributions are part of multiple arrangements that need to be treated as a single transaction, as explained in paragraph B 97 of IFRS 10. An investment is accounted for using the equity method starting from the date it becomes an associate or a joint venture. When acquiring the investment, any difference between the cost of the investment and the entity's share of the net fair value of the investee's identifiable assets and liabilities is treated in a specific way. Goodwill related to the associate or joint venture is included in the carrying amount of the investment. However, amortization of that goodwill is not allowed. If the entity's share of the net fair value of the investee's identifiable assets and liabilities exceeds the cost of the investment, the excess is recognized as income. This income is included in the entity's share of the associate or joint venture's profit or loss for the period in which the investment is acquired. After acquisition, appropriate adjustments are made to the entity's share of the associate's or joint venture's profit or loss. For example, these adjustments might account for depreciation of assets based on their fair values at the acquisition date. Similarly, adjustments are also made for impairment losses, such as those related to goodwill or property, plant, and equipment. When applying the equity method, the entity uses the most recent financial statements of the associate or joint venture. If the reporting period of the associate or joint venture differs from that of the entity, the associate or joint venture should prepare financial statements as of the same date as the entity's financial statements. This is required unless it is impracticable to do so. When the financial statements of an associate or a joint venture are prepared at a different date than the entity's financial statements, adjustments must be made for significant transactions or events that happen between those two dates. However, the difference between the reporting periods of the associate or joint venture and the entity cannot be more than 3 months. Also, the length of the reporting periods and any difference between their end dates must remain consistent from one period to the next. The entity's financial statements must be prepared using uniform accounting policies for similar transactions and events in similar circumstances. If an associate or joint venture uses different accounting policies for transactions and events, adjustments should be made to align their policies with those of the entity when applying the equity method. If an entity is not an investment entity itself, but has an interest in an associate or joint venture that is an investment entity, it can choose to keep the fair value measurement that the investment entity applies to its interests in subsidiaries. This choice, called an election, must be made separately for each investment entity, associate, or joint venture. The election is made at the latest of 3 events: when the investment entity, associate, or joint venture is first recognized, when it becomes an investment entity, or when it first becomes apparent. Also, if the associate or joint venture has cumulative preference shares that other parties hold and classify as equity, the entity must adjust its share of profit or loss to account for dividends on those shares. This adjustment happens regardless of whether the dividends have been declared or not. If an entity's share of losses from an associate or joint venture equals or goes beyond the value of its investment, the entity stops recognizing any further losses. The investment's value includes the carrying amount of the investment under the equity method, plus any long-term interests that effectively form part of the entity's net investment. For example, items where repayment is neither planned nor expected in the near future, like preference shares or long-term loans, are considered extensions of the investment. However, this does not include trade receivables, trade payables, or long-term receivables backed by sufficient collateral, such as secured loans. If losses go beyond the entity's investment in ordinary shares, those losses are charged against other components of the investment, starting with the least senior interests first, meaning those with the lowest priority in liquidation. Once the entity's interest in the associate or joint venture is reduced to zero, it only recognizes additional losses and records a liability if it has a legal or constructive obligation or if it has made payments on behalf of the associate or joint venture. If the associate or joint venture later reports profits, the entity begins recognizing its share of those profits again, but only after those profits fully covered the losses it previously didn't recognize. After applying the equity method, including recognizing the associate's or joint venture's losses, the entity must assess whether there is any objective evidence that its net investment is impaired. The net investment is considered impaired, and impairment losses are recognized only if there is clear evidence that one or more events have occurred after the initial investment, and these events have negatively affected the estimated future cash flows from the investment in a way that can be reliably measured. It might not be just one specific event causing the impairment, rather, it could be a combination of several events working together. Importantly, expected losses from future events, even if likely, are not recognized. Some examples of objective evidence of impairment include situations such as significant financial difficulty experienced by the associate or joint venture, or when there's a breach of contract, like missed or late payments by the associate or joint venture. It could also be when the entity, due to economic or legal reasons tied to the associate's or joint venture's financial struggles, grants concessions that it otherwise wouldn't consider. Another sign is when it becomes likely that the associate or joint venture will enter bankruptcy or undergo some form of financial reorganization. Lastly, the loss of an active market for the net investment because of these financial difficulties can also indicate impairment. It's important to note that just because an active market disappears, meaning the associates or joint venture's equity or financial instruments are no longer publicly traded, this alone is not considered evidence of impairment. Similarly, a downgrade in the credit rating or a drop in the fair value of the associate or joint venture by itself doesn't prove impairment either. However, when combined with other information, these factors might indicate impairment. Beyond these financial signals, there can be other objective evidence of impairment. For example, significant adverse changes in the technological, market, economic, or legal environment where the associate or joint venture operates can suggest that the investment's cost might not be fully recoverable. Also, a significant or prolonged decline in the fair value of an investment in an equity instrument below its original cost is another clear sign of impairment. Goodwill that's part of the carrying amount of an investment in an associate or joint venture isn't recognized separately. Because of this, it isn't tested for impairment on its own like goodwill under IAS 36. Instead, the entire carrying amount of the investment is tested as a single asset. This means the recoverable amount, either the higher of its value in use or its fair value less cost to sell, is compared to its carrying amount whenever there's an indication the investment might be impaired. If an impairment loss is recognized, it isn't allocated to specific assets like goodwill within the investment. Later, if the recoverable amount of the investment increases, any reversal of that impairment loss is recognized following IAS 36. When calculating the value in use of the investment, the entity estimates several factors to come to a reliable figure. When determining the value in use of the investment, the entity estimates its share of the present value of the expected future cash flows generated by the associate or joint venture. This includes cash flows from its operations, as well as the proceeds from eventually selling the investment. Alternatively, the entity can estimate the present value of the future cash flows expected from dividends it will receive and from the ultimate sale of the investment. Both approaches, when using appropriate assumptions, should arrive at the same result. The recoverable amount should be assessed separately for each associate or joint venture, unless the associate or joint venture's cash inflows aren't largely independent from the entity's other assets. In an entity's separate financial statements, investments in associates or joint ventures are accounted for following the guidance in paragraph 10 of IAS 27, as amended in 2011. This standard must be applied for annual periods starting on or after January 1st, 2013, but earlier application is allowed. If an entity applies the standard early, it must disclose this and apply IFRS 10, IFRS 11, IFRS 12, and the amended IAS 27 all at the same time. Later, IFRS 9, issued in July 2014, amended certain paragraphs, and entities must apply these amendments when they adopt IFRS 9. Additionally, amendments to IAS 27 related to the equity method in separate financial statements were issued in August 2014. These amendments apply to annual periods beginning on or after January 1st, 2016, and must be applied retrospectively in line with IAS 8. Early application is also allowed, but must be disclosed. The amendments about the sale or contribution of assets between an investor and its associate or joint venture, issued in September 2014, changed some paragraphs and added new ones. These amendments are applied prospectively for asset sales or contributions in annual periods starting on a date set later by the IASB. Early application is allowed, but if done, the entity must disclose it. Separately, amendments related to investment entities and the consolidation exception issued in December 2014 modified several paragraphs and added a new one. These apply for annual periods beginning on or after January 1st, 2016. Early application is also permitted here, with a disclosure requirement if applied early. The Annual Improvements to IFRS Standards 2014-2016 cycle, issued in December 2016, amended paragraphs 18 and 36A. These amendments must be applied retrospectively for annual periods starting on or after January 1st, 2018. Early application is allowed but must be disclosed. IFRS 17, issued in May 2017, amended paragraph 18. Entities apply this amendment when they adopt IFRS 17. The update titled Long-Term Interests in Associates and Joint Ventures, issued in October 2017, added a new paragraph 14A and removed paragraph 41. These changes are applied retrospectively for annual periods starting on or after January 1st, 2019, except where specified otherwise. Early application is permitted with disclosure. When an entity applies the amendments in paragraph 45G at the same time as it first applies IFRS 9, it must follow IFRS 9's transition requirements for the long-term interest described in paragraph 14A. If the entity applies the amendments in paragraph 45G after it has already applied IFRS 9, then it must apply the necessary IFRS 9 transition requirements for those long-term interests. In doing so, any references to the date of initial application in IFRS 9 should be understood as the start of the reporting period when the entity first applies these amendments. The entity is not required to restate previous periods to reflect these changes. However, it may restate prior periods if it can do so without using hindsight. When an entity first applies the amendments in paragraph 45G and is using the temporary exemption from IFRS 9 under IFRS for insurance contracts, it does not have to restate prior periods to reflect these amendments. The entity can choose to restate prior periods only if it can do so without using hindsight. If the entity decides not to restate prior periods when applying paragraphs 45.1 or 45J, then at the date it first applies the amendments, it must recognize in opening retained earnings, or another equity component if appropriate, any difference between the previous carrying amount of the long-term interests described in paragraph 14A and the new carrying amount of those long-term interests at that date. If an entity applies this standard but hasn't started applying IFRS 9 yet, then any mention of IFRS 9 should be understood as a reference to IAS 39 instead. This standard replaces IAS 28, which was about investments in associates and was last revised in 2003. IAS 28, Investments in Associates, as revised in 2003, was approved for issue by the 14 members of the International Accounting Standards Board. The board was chaired by Sir David Tweedy, with Thomas E. Jones as vice chairman. The other members included Mary E. Barth, Hans-Georg Bruns, Anthony T. Cope, Robert P. Garnett, Gilbert Gellard, James J. Leisenring, Warren J. McGregor, Patricia L. O'Malley, Harry K. Schmid, John T. Smith, Jeffrey Whittington, and Tatsumi Yamada. The amendments titled Sale or Contribution of Assets between an Investor and its Associate or Joint Venture, amendments to IFRS 10 and IAS 28, issued in September 2014, were approved for issue by 11 of the 14 members of the International Accounting Standards Board. Mr. Kabarek, Miss Lloyd, and Mr. Ochi dissented from the issue of these amendments. Their dissenting opinions are set out after the basis for conclusions. The board members at the time were Hans Hugervorst, chairman, Ian McIntosh, vice chairman, Stephen Cooper, Philippe Danjou, Martin Edelman, Patrick Finnegan, Amaro Luis de Oliveira Gomes, Gary Kabarek, Suzanne Lloyd, Takatsugu Ochi, Daryl Scott, Chungwoo Su, Mary Tokar, and Weiguo Zhang. The amendments titled Investment Entities, Applying the Consolidation Exception, amendments to IFRS 10, IFRS 12, and IAS 28, issued in December 2014, were approved for issue by all 14 members of the International Accounting Standards Board. The board members at that time were Hans Hugervorst, chairman, Ian McIntosh, vice chairman, Stephen Cooper, Philippe Danjou, Amara Louise de Oliveira Gomez, Martin Edelman, Patrick Finnegan, Gary Kabarek, Suzanne Lloyd, Takatsugu Ochi, Daryl Scott, Chungwoo Su, Mary Tokar, and Weiguo Zhang. The effective date of amendments to IFRS 10 and IAS 28, issued in December 2015, was approved for publication by all 14 members of the International Accounting Standards Board. The board members included Hans Hugervorst, chairman, Ian McIntosh, vice chairman, Stephen Cooper, Philippe Danjou, Martin Edelman, Patrick Finnegan, Amaro Gomes, Gary Kabarek, Suzanne Lloyd, Takatsugu Ochi, Daryl Scott, Chungwoo Su, Mary Tokar, and Weiguo Zhang. The long-term interests in associates and joint ventures, amendments to IAS 28, issued in October 2017, was approved for issue by 10 of the 14 members of the International Accounting Standards Board. Mr. Ochi dissented, and his dissenting opinion is included after the basis for conclusions. Messrs. Anderson and Liu, along with Ms. Tarka, abstained from voting due to their recent appointments to the board. The members who approved the amendments included Hans Hugervorst, chairman, Suzanne Lloyd, vice chairman, Nick Anderson, Martin Edelman, Françoise Flores, Amara Louise de Oliveira Gomes, Gary Kabarek, Jiankao Liu, Takatsugu Ochi, Daryl Scott, Thomas Scott, Chungwoo Su, Antarksha, and Mary Tokar. Thank you for completing our course and for the attention and dedication you've shown throughout. We are happy to have contributed to your professional development and encourage you to help us improve by providing your feedback. If you have any questions or suggestions, feel free to reach out via email at info@qlever.al or through the contact forms on our website. Also, we invite you to follow us on social media and our YouTube channel to stay updated on upcoming training sessions. Thank you once again, and we look forward to seeing you in our future courses.